future and option trading. Now, what is a future? What is an option? To understand future and options, you have to understand the term derivatives. Now, what is a derivative? Again, another terminology you might be thinking. First future, options, and then now derivatives. Thinking that it is complicated. It's not. I'm going to give you a very simplistic example or understanding of what exactly derivative means. Derivative, as a definition, says that derivative is a financial instrument which derives its value from the underlying asset. Understand? I don't think so. I will make it clear. Derivative is a financial instrument. So what is a financial instrument? Example of financial instrument could be shares, currency, bonds, life insurance, fixed deposits. So these are financial instruments. Similarly, derivative is also a financial instrument. So derivative is a financial instrument which derives its value from the underlying asset. So what the second part means, derives its value from the underlying asset. Derivative, understand, as a financial instrument do not have a value of its own. It derives its value from the underlying asset. Let's take an example to understand that. Every one of you might be using credit cards or debit cards, and you also might be having a payback card. So payback card are nothing where you actually accumulate all the bonus points or all the rewards point once you use credit cards and debit cards. So whenever you swipe in your credit card or debit card online or through any merchants or any offline shops, when you buy something, you get certain reward points which get accumulated in your payback cards. So payback card here is a derivative, and credit card and debit card is your underlying asset. Whenever you swipe in your credit card and debit card, the value of payback cards increases. Understand? I give you another example. Reliance Industries shares. Reliance Industries share is an underlying asset, while Reliance future is a derivative asset. Similarly, US exchange, US dollar is an underlying asset, and US dollar future is a derivative asset. So there could be many examples. Nifty could be underlying asset, and Nifty future could be a derivative asset. Future, I will tell you later on what exactly you mean by future. So let's get by one. To give another very simplistic example to understand what a derivative is about, you all are listening to my webinars and content every week. You know that every Saturday, 11 a.m., I take a webinar of different topics on finances and investments, of technicalities and concept. So you all are derivatives, example, and I am the underlying asset. What does that mean? If my knowledge increases, your knowledge will also increase. Your information will also increase. So if my knowledge and information increases, I will deliver that things to you, and your knowledge and information will also increase. So your knowledge and information value is getting derived from my knowledge and information, right? So you are a derivative, I am the underlying asset in that simplistic term example. So now you might be clear idea about what derivative is all about. Okay, so I move to the next point. What are the different types of derivatives? There are 4 types of derivatives: forwards, futures, options, and swaps. In Indian stock market, we have removed forwards and swaps. We have talked about futures and options only. Now the question is, why derivatives actually happen? Why it is required? Reliance Industries shares, ICICI Bank shares, it's okay, we do trading in that thing. Why it is derivative is happening? Why it is required? To understand why derivative happen, we have to understand 2 terminologies, which is called speculations and hedging. Now what is a speculation? Speculation is a very simple terms that we speculate. Today Nifty, for say example, is 11,000. We are speculating Nifty will go to 12,000. So that's a speculation. We are assuming, we are speculating. Or else Nifty is 11,000. We are speculating in a month's time or 2 months time, Nifty will go to 9,000. So it will go down. Reverse speculations. So speculation is all about making profit. Speculation, that's one concept of derivatives. Why derivative happen? And second is the hedging. Hedging, for example, today I invested 10 crore in stock market, and after a month's time, market goes down. My value of 10 crores come to 6 crore. Now, what is the hedging? By hedging, we will minimize or reduce the loss of what is going to happen in the market. So, difference between speculation and hedging is speculations, when you make profit is to make profit, and hedging is to reduce your loss. I am going to tell you about how actually derivatives or future and options trade happen in stocks in subsequent seminars and content. So to make it very clear and go step by step so that you get clear about the entire ideas about what the concept is about. Now, what is future? Futures are derivative contracts. You understand what is derivative financial contract? Derivative financial contracts where you need to obligate the parties, where the parties have to obligate the transactions to transact an asset and at a predetermined date and price. I will tell you these three important steps very clearly to you. Obligate the parties. What is the difference? What is the meaning of obligate the parties? Suppose, say for example, today Nifty is at 11,000. What I am going to do that? Sell Nifty today, and I am speculating that Nifty will go down in a month's time to 9,000. So what I will going to do today that in a future contract, a derivative contract, I will sell Nifty today and buy Nifty a month later at 9,000. So I will make a profit 11,000 minus 9,000, 2,000 rupees, which is called a short sell. But here, understand, it can happen either way also. Nifty is 11,000, it can go to 13,000. That's also a speculation. Nifty is 11,000, I'm doing a short selling because I presume the market will go down 9,000. Now here the interesting point is that today I am selling Nifty at 11,000 and buying at 9,000. So in a future transactions, there are two parties involved. One a future seller, one a future buyer. So what happened tomorrow that my future seller or future so if I'm going to buy in future, there has to be a future seller. He can deny many bechuga. But if any two parties are involved in a future derivative contract, they have to execute that contract. They cannot move away. So that's why it is said that it is an obligation of both the parties to do the transaction if you are entering into a future contract, whether you are making profit or whether you are making. First part is clear. I am coming to the second part, to transact an asset. What is it called to transact an asset? What are the assets? As I told earlier, assets could be commodities, index, stocks, exchanges, anything of financial nature. Third is at a predetermined future date and price. Now, what is a predetermined future date and price? You have to understand that. This is exactly a Nifty future, which I have taken yesterday, 31st July. You can see here the three dates are given. Always remember, a future contract will have an expiry date. So what are the expiry date? There are three dates will happen. One is a near month, which is in August. If it is a July, suppose say today is 31st of July, then you have a September, then you have a October. So you will always see 3 dates in Nifty, 3 dates in future contract. Next month, next to next month, and next to next to next month. So next month, which is called a near, next month will be called next, and the third month will be called far away. So here, if it is a July, then we will show that 27th August will be the expiry date of the Nifty future. Similarly, 24th September and 29th October will be the expiry date. Now, you might be thinking, why there is 27th and 24th and 29th? Why this data fixed? It is not fixed. Understand, in future contract, last Thursday of every month is an expiry date. So, 27th August is the last Thursday of August. 24th September is the last Thursday of September, and 29th October is the last Thursday of October. So that is why it is automatically comes that way. If Thursday is a national holiday or holiday for any sense, then subsequent previous day, Wednesday will take into account. So you understand the concept of near month, next month, and far month. So this will always be there when you are doing the transactions. So I have discussed about this point at a predetermined future date. Now come to the point of predetermined future price. To understand predetermined future price, I have taken an example of ICICI Bank July future.